Well, a euphoric start to the market saw stocks bolt out of the gate. The Dow was up 283 points, and then, well, it faded into the close, and we finished slightly lower. I got to tell you, probably was the most challenging session of 2018, because at one point we were down 400 points from the intraday high. So the bears, they came out growling, believe it or not. Right out the gate, the bears were sort of making their move, and there was talk of a blow-off top as the major indices were shattering these intraday records. Keep in mind, the swiftest 1,000-point move in Dow Jones history, just 7 days. That's a mind-boggling move in that milestone, considering the old record was 24 days. Now, there are signs that this kind of session, that was going to happen sooner or later, right? We had a series of sessions that were powered by panic buying. I told you about it last week. But that said, the Dow is still up more than 4% for the year. And more importantly, the underlying fundamentals are still in place. Now, near term, though, the market move can be it can move for an assortment of reasons, let's face it, beyond fundamentals. So on that note, I want to look at two factors tonight that I take into account when assessing the market, not long term, but on a shorter term basis, technical factors and behavioral analysis. Now, with technical factors, this market, having lurched straight up, is really a million miles away from its two key moving averages. I usually use the 50 and 200-day moving averages on an exponential basis. Right now, those numbers are 24,399 and 22,320. We're not near there. So your other key numbers would be 25,633. That was the low on Friday. Now, if it hadn't held today, this would have been what they called an outside day with a higher high and a lower low than a prior session, and that's usually a bearish sign. Then 24,824. That's where the Dow broke out at the beginning of the year and took off like a rocket. Resistance becomes support. You want to see that hold. Then there's behavioral analysis. For the years, the market rally has been deemed the most hated rally in history. But you know what? The fact of the matter is that this rally was the most ignored in history. The level of indifference, as measured by fund flows and sentiment, hovered at record levels for long periods of time. But finally, it happened. In late November, individual investors got very excited, and according to the American Association for Individual Investors, optimism spiked to a 7-year high in the week ending January 3rd. Pulled back a little bit last week, but still 10 percentage points higher than your average bullishness level historically. Interestingly, institutional investor confidence actually declined in December and actually peaked in July, reflecting lower equity holdings. This is for the big guys, right, according to State Street Bank. Unconventional wisdom. Okay, here it is. Conventional wisdom always says that we should always zig when individual investors are zagging. But I think that they have been wiser than the professionals and who have continued to underperform. I also think that the old Wall Street axiom about the dumb individual investor is now seen as a canard, because more and more individual investors are self-directed, they're disciplined, and they have a knowledge of market history. This doesn't mean that they're never going to blink or panic, but right now, buying the dip is what everybody's really worried about more than anything else. So as money continues to pour into this market from the sidelines, I think, you know what, you might get some more anxiety, you may get less conviction with this new money, but I still think that it's the pros who need to find a way to make up lost ground. We may get a return of volatility. Today, the so-called VIX index popped more than 14%, but you got to remember, this thing is near a 5-year low. So while there could be wilder gyrations, I don't think we're going to get a lot of days like today with 400-point swings in the Dow. That said, I'm guessing the tops based on the market, the charts and the emotions. Listen, it's hard to figure out where a top is going to be. So you might want to pick a near-term top to keep in mind that there are millions of people out there that have missed this rally. And if you go back to March of 2009, there are literally millions of people who were initially proud that they got out, right? The market was falling off, it sold off. But since then, they've lamented the fact that they've waited for the next leg down, and they've missed one of the best rallies in their whole life.